Welcome to the 200% Club. Lenders are facing a dilemma. Do they chase mortgage lending growth and embed more risks into their portfolios, or accept the consequences of lower growth and returns as household debt explodes? Hi, I'm Martin North, Principal Analyst at Digital Finance Analytics. Welcome to the Property Imperative Weekly to the 20th of January 2018. In our latest digest of finance and property news, we start with news from the ABS, who revised housing debt upward to include mortgage borrowing within superannuation funds. So the total household liabilities have now been increased by approximately 3%. The change, which reflects the accurate measurement of property investments by self-managed superannuation funds, lifted the figure up from 194% to 200% of income. This is a record that no one should be proud of. It also again highlights the risks in the system. Australian households are in the 200% club. The final set of data from the ABS Lending Finance to November 2017 also highlights again the changes underway in the property sector. Within the housing series, owner-occupied lending for construction fell 0.88% compared with the previous month. That's down $17 million. Lending for the purchase of new dwellings rose 0.25%, up $3 million. And loans for the purchase of existing dwellings rose 0.11%, up $12 million. The refinancing of existing owner-occupied dwellings rose 0.28%, up $16 million. And looking at investors, borrowing for new investment construction rose 5%, up $65 million, while the purchase of existing property by investors fell $74 million, for individuals down 0.75%, and for other investors down $21 million or 2.28%. So overall, there was a fall of $16 million across all the categories. We see a fall in investment lending overall, but it is still 36% of all new lending flow, so hardly a startling decline. And those calling for the weakening of credit lending rules to support home price growth would do well to reflect that 36% is a big number. That's double that identified as risky by the Bank of England, who became twitchy at 16%. Looking then across all lending categories, personal fixed credit, personal loans mainly, rose $70 million, up 1.74%, while revolving credit cards mainly, fell $4 million or 0.18%. Fixed commercial lending, other than for property investment, rose $231 million or 1.12%, while lending for investment purposes fell 0.25% or $30 million. The share of fixed business lending for housing investment fell to 36.7% of all business lending flows, compared with 41% in 2015. And revolving business credit rose $6 million, up 0.06%. Now, a highlight was the rise in first-time buyer owner-occupied loans, which were more than 1,000 higher on the prior month, as buyers reacted to the incentives available and attractive rates. This equates to 18% of all transactions. Non-first-time buyers fell 0.5%. The average first-time buyer loan rose again, and it's now standing at $327,000, up 1% from last month. We don't think the data gives any support for the notion that regulators should loosen the lending rules, as some are suggesting. That said, the incentives for first-time buyers are indeed having an effect. In essence, persuading people to buy into the market at the top, even as prices slide. I think people should be really careful, as the increased incentives are there to try and keep the mortgage lending balloon in the air for longer. So what can we conclude from all of this? Investment lending momentum is on the turn, though there is still lots of action in the funding of new property construction for investment, mostly in the high-rise blocks around our major centres. But in fact, momentum appears to be slowing in Brisbane, Sydney and Melbourne. This does not bode well for the construction sector in 2018, as we posit a fall in residential development only partially offset by a rise in commercial and engineering construction, much of which is of course state and federal funded. What I'm noticing is that those in the construction sector, from small builders through to subcontractors, have significantly lower confidence levels than they did 6 months ago, based on our surveys. And whilst lending to first-time buyers is up, there are risks attached to this, as we'll discuss further later. The good news in these statistics is that lending to businesses other than for housing investment is rising a little, but businesses are still looking to hold costs down and borrow carefully. This means economic growth will be slow and potential wage growth will remain contained. Fitch Ratings says Australian banks' profits growth is likely to slow in 2018 as global monetary tightening pushes up funding costs, loan impairment charges rise, and tighter regulation has an impact on business volumes and compliance costs from the 15 or so inquiries or reviews currently across the sector, according to UBS. They say Australian banks are more reliant on offshore wholesale funding than global peers, as the superannuation scheme here has created a lack of domestic customer deposits. Global monetary tightening could therefore push up banks' funding costs, and indeed the 10-year US bond yield is moving higher, and whilst the US mortgage rates were only moderately higher today, the move was enough to bring them to the highest levels since the northern spring of 2017. The main risks to the bank's performance stem from high property prices and household debt. And Australian banks are more highly exposed to residential mortgages than international peers, while households could be sensitive to an eventual increase in interest rates or a rise in unemployment, given that their debt is nearly 200% of disposable income. Indeed, Tribeca Investment Partners said this week that local equities may also be hurt by troughs in the domestic property market. A heavily indebted household sector, they said, that is experiencing flat to negative real income growth, as well as dealing with higher energy and healthcare costs, and which has drawn down its savings rate, is unlikely to fill the gap in growth. In local economic news, the latest ABS data on employment to December 2017 shows the trend unemployment rate decreased slightly to 5.4% in December, after the November 2017 figure was revised up to 5.5%. The trend unemployment rate was 0.3 percentage points lower than a year ago, and is at its lowest point since January 2013. The seasonally adjusted number of persons employed increased by 35,000. The seasonally adjusted unemployment rate increased 0.1 percentage points to 5.5%, and the labour force participation rate increased to 65.7%. The number of hours worked fell in the month. By state, trends employment rose in the Northern Territories, Western Australia and South Australia, and over the past year all states and territories recorded a decrease in their trend unemployment rates, except the Northern Territories, which increased 1.6 percentage points. The states and territories with the strongest annual growth in trend employment were Queensland and the ACT, both 4.6%. Followed by New South Wales at 3.5%. The ABA released new research, the Endelman Intelligence Research, conducted late last year, which tracks community trust and confidence in the banks. Whilst progress may be being made, the research shows Australian banks are behind the global benchmark in terms of trust. Based on the annual Trust Barometer study released in January 2017, Australia remains 4 points behind the global average. The Australian Financial Review featured some of our recent research on the problem of refinancing interest-only loans. Many interest-only loan holders simply assume that they can roll their loans on the same term when it comes up for periodic review. But many will get a nasty surprise thanks to now tighter lending standards and higher interest rates. Others may not even realise that they have an interest-only loan. Thousands of home owners face a looming financial crunch as 60 billion of interest-only loans written at the height of the property boom reset at higher rates and terms over the next 4 years. Monthly repayments on the typical $1 million mortgage could be increased by more than 50% as borrowers start repaying the principal on their loans, stretching budgets and increasing risk of financial distress. DFA analysis shows that over the next few years, a considerable number of interest-only loans which come up for review will fail current underwriting standards. So households will be forced to switch to more expensive principal and interest loans, assuming they find a lender, or even sell. The same drama played out in the UK a couple of years ago when they brought in tighter restrictions on interest-only loans. And the value of loans is significant and may be understated. We also featured research on the Bank of Mum and Dad this week, now a top 10 lender in Australia. Our analysis shows that the number and value of loans made to first-time buyers by the Bank of Mum and Dad has increased to a total estimated at more than $20 billion, which places it amongst the top 10 mortgage lenders in Australia. Savings for a deposit is very difficult at a time when many lenders are requiring a larger deposit as loan-to-value rules are tightened. The rise of the importance of the Bank of Mum and Dad is a response to rising home prices against flat incomes and the equity growth which those already in the market have enjoyed. This enables an intergenerational cash switch which those fortunate first-time buyers with wealthy parents can enjoy. In turn, this enables them also to gain from the more generous first home owner grants, which are also available at the moment. Those who do not have wealthy parents are at a significant disadvantage. Whilst help comes in a number of ways, from a loan to a gift or ongoing help with mortgage repayments or other expenses, where a cash injection is involved, the average is now around $88,000. It does vary across the states. But overall, around 55% of first-time buyers are getting assistance from parents, with around 23,000 in the market the last quarter. There was also research this week from LF Economics which showed that some major lenders are willing to accept a 20% deposit for a mortgage from the equity in an existing property, and in so doing avoids the need for expensive lenders' mortgage insurance. Both arrangements are essentially cross-leveraging property from existing equity and is risky behaviour in a potentially falling market. It's more evidence of the length banks are willing to go to keep their mortgage books growing. We think these portfolio risks are not adequately understood. So we conclude that banks are caught between trying to grow their books in a fading market by offering cheap rates to target new borrowers and accept equity from existing properties, thus piling on the risk, whilst dealing with rising overseas funding and in a flat income environment where they face heightened risks from borrowers as they join the 200 Club. And that's the Property Imperative Weekly to the 20th of January 2018. If you found this useful, do leave a comment, subscribe to receive future updates, and check back for our latest posts. I'm Martin North, Principal Analyst at Digital Finance Analytics. Many thanks for taking the time to watch.